$100,000. That's what both Jake and Marcus have sitting in their accounts right now. Same age, same starting point, both 30 years old, both disciplined enough to actually save it. But they're about to make completely different decisions about what to do with it. And 20 years from now, those decisions are going to produce two very different lives and two very different numbers in their accounts. Real estate versus stocks. It's the most heated debate in personal finance. Everyone has an opinion. Your uncle who bought a rental property in the 90s swears by real estate. Your coworker who maxed her Roth IRA through the pandemic swears by index funds. Your dad who did both is somehow the most annoying person at Thanksgiving. But here's the problem with almost every version of this debate. People pick a side based on what they know, who they trust, or what sounds good, before they ever actually run the math. Today, we're running the math. Real numbers, real 20-year timelines, and the honest truth that most finance channels won't tell you, which is that this question doesn't have one right answer. It has a right answer for you specifically, based on how you actually want to live. I'm Ash. I read the boring financial stuff so you don't have to. Let's get into it. And hey, if you've been watching for a while and haven't subscribed yet, now would be a great time. Take 2 seconds, hit that button, and let the algorithm know you're serious about your money. Okay, let's run this thing. Part 1. Meet Jake and Marcus. Jake and Marcus are both 30 years old. Both have exactly $100,000 in cash ready to invest. Neither inherited it, they saved it over years of working and being intentional with their money. But they think about money differently. Marcus doesn't want another job. He works 40+ hours a week already. He wants his money to grow while he sleeps. He wants to check an app, see a number, and not think about it again until he needs it. He values simplicity and liquidity, the ability to access his money when he needs it without selling a house first. Jake is a different kind of person. He's comfortable with complexity. He's willing to put in work after hours if it means building something tangible he can see and touch. He's not scared of spreadsheets or property managers or tenants who call at inconvenient times. He wants leverage, the ability to use other people's money to control assets he couldn't otherwise afford. Same starting point, two completely different philosophies, and we're going to follow both of them for 20 years. Part 2. Marcus takes the stock market route. Marcus does something very simple. He takes $100,000 and puts it into a broad market index fund, something that tracks the S&P 500, the 500 largest publicly traded companies in the United States. He doesn't try to pick stocks. He doesn't hire an active fund manager. He doesn't read earnings reports. He just sets up automatic contributions, turns on dividend reinvestment, and leaves it alone. The S&P 500 has returned an average of roughly 10.5% annually over the last 100 years. That's with dividends reinvested, which account for about 40% of the total long-term gain. Over the last 30 years specifically, a period that included the dot-com crash, the 2008 financial crisis, COVID, and everything in between, the average annual return was 10.4% according to Fidelity's historical data. Now, it's important to be honest about what 10% actually means. Adjusted for inflation, the real return is closer to 7%, and in any given year, the market can be up 30% or down 30%. The 10% only materializes over long periods. But Marcus isn't touching this money for 20 years, so the math works in his favor. $100,000 at 10% annually, compounded over 20 years, grows to approximately $672,000. He never called a tenant, he never fixed a leaky roof, he never hired a property manager or filed a Schedule E on his taxes. His money just compounded. And here's the part that often gets glossed over. His investment is completely liquid. On any given Tuesday, Marcus can sell it all and have cash in his account within 2 days. That flexibility has real value that almost nobody puts a dollar number on, but it matters enormously when life throws something at you that costs money. Part 3. Jake takes the real estate route. Jake does something very different. He doesn't buy $100,000 property. He uses his $100,000 as a 20% down payment on a $500,000 home. He takes out a $400,000 mortgage and now controls a $500,000 asset with only a fifth of his own money. This is the mechanism that makes real estate so powerful and so different from stocks. It's called leverage. In the stock market, $100,000 buys you $100,000 of assets. In real estate, that same $100,000 can control $500,000 worth of property. And appreciation applies to the total value of the property, not just the portion you own. Jake buys this property as a rental. He finds a tenant. The tenant pays rent every month. Jake uses that rent to cover the mortgage payment, property taxes, insurance, and a maintenance reserve. Done correctly, the property more or less pays for itself. This is the part that real estate investors love to explain at parties. His tenants are, quite literally, buying the property for him. Every month's rent payment that covers the mortgage is equity that Jake is building without spending his own paycheck on it. Now, residential real estate in the United States has historically appreciated at about 4% annually. That's the long-term figure going back to 1967, according to the FHFA House Price Index and the Case-Shiller National Home Price Index. 4% is the boring, sustainable, long-term figure. At 4% annually over 20 years, Jake's $500,000 property is now worth approximately $1,095,000. On the surface, Jake's asset has more than doubled in value. Marcus has a portfolio worth $672,000. Jake's house is worth over $1 million. That looks like a landslide victory for real estate. But we're not done yet. Part 4. The number that changes everything. Before we declare a winner, let's talk about the real return on cash invested, because this is where the leverage story gets genuinely powerful and also genuinely complicated. Marcus invested $100,000 and ended up with $672,000. That's a total gain of $572,000 on his original investment. In percentage terms, that's a return of 572% on his actual cash. Now watch what happens with Jake's leverage. Jake invested $100,000 in cash. His property grew from $500,000 to just over $1,095,000, a gain of approximately $595,000 in gross appreciation alone. That $595,000 gain happened on a $100,000 cash investment. That's almost 6 times his money, purely from appreciation on the same starting amount Marcus used. On raw return on cash invested math, leveraged real estate can be extraordinary. But here's where the story gets more complicated, because that $595,000 in gross appreciation is not what Jake actually keeps. Part 5. The real costs of real estate. Real estate has something that index funds simply don't have: frictional costs. And over 20 years, those costs are substantial. Let's walk through them honestly. Property taxes. As Jake's home appreciates, so does his property tax bill. The average effective property tax rate in the U.S. is about 1.1% of the home's value annually. On a property that starts at $500,000 and grows to over $1 million, that's somewhere between $5,500 and $11,000 per year for 20 years. A rough estimate over the full period could total well over $120,000 just in property taxes. Insurance. Homeowners insurance on a $500,000 rental property runs roughly $2,000 to $4,000 per year, depending on location. Over 20 years, that's another $40,000 to $80,000. Maintenance and repairs. The general rule of thumb is 1 to 2% of the property's value per year in maintenance. On a $500,000 property, that's $5,000 to $10,000 a year. Over 20 years, $100,000 to $200,000. And that's the average. The HVAC system that dies in year 8, the roof that starts leaking in year 14, the plumbing issue that hits at the worst possible time. These aren't hypotheticals, they happen. Property management. If Jake hires a professional property manager, which most landlords eventually do, that typically costs 8 to 10% of monthly rent. On a property renting for $3,000 a month, that's $240 to $300 every single month, or roughly $57,000 to $72,000 over 20 years. Vacancies. No property stays rented 100% of the time. Industry average vacancy rates run around 5 to 7% annually. A few months without a tenant over 20 years means Jake is covering that mortgage out of his own paycheck. And there's one more cost that the source material gets right, and most people completely underestimate: mortgage interest. A $400,000 mortgage at around 6.5%, which is roughly where rates have been in 2025 and 2026, generates enormous total interest. Over 30 years, a $400,000 loan at 6.5% costs approximately $511,000 in interest. That is more than the original loan amount. When you add up property taxes, insurance, maintenance, property management, vacancy losses, and mortgage interest over 20 years, the real total cost of ownership can easily consume $250,000 to $350,000 or more of Jake's gross gain. So Jake's property appreciated by $595,000 gross, but his true net worth, after all costs, is realistically in the $300,000 range, maybe closer to $250,000 in a higher cost environment. Meanwhile, Marcus paid essentially zero fees in a low-cost index fund, expense ratios of 0.03%, and had zero maintenance calls, zero vacancy losses, and zero property tax bills. Part 6. The verdict on gross net worth. So who actually wins? Purely on gross asset value, Jake looks better on paper. But in terms of liquid, accessible net worth, after accounting for real costs, the gap closes significantly. And depending on specific assumptions, Marcus's portfolio can actually be competitive or even come out ahead in certain scenarios. Here's what we can say with confidence. If Jake is disciplined, keeps costs under control, finds reliable tenants, doesn't over-leverage, and manages the property efficiently, real estate's leverage often edges out a simple index fund strategy in terms of total return on cash invested over long periods. But here's the honest nuance that almost nobody puts in the headline. Real estate is not a passive investment. It is a highly profitable part-time business that happens to also build equity over time. Jake didn't build $595,000 in appreciation without doing any work. He managed a property for 20 years. He dealt with tenants. He handled maintenance calls. He filed quarterly taxes. He negotiated lease renewals. He spent mental energy that Marcus spent on other things. The correct comparison isn't really which made more money, it's which was the better use of your $100,000 and your time combined. Part 7. The behavioral argument for real estate. Here's a counterintuitive argument for real estate that doesn't get enough attention. Real estate is a behavioral straitjacket for the middle class, and that might be its most underrated feature. When the stock market drops 20%, as it did in 2022, as it did in 2020, as it did in 2008, Marcus's portfolio drops with it, and he can panic sell it with a click of a button from his phone in 2 in the morning in a moment of fear. Research consistently shows that the average investor earns far less than the market actually returns because they buy high and sell low due to emotion. One J.P. Morgan study found that while the S&P 500 returned about 10% annually over a 20-year period, the average investor in that same period earned only about 4.3%. The market made 10%. The human behavior made 4.3%. That gap is enormous. Jake can't panic sell a house at 2 in the morning. Even if he wanted to, selling a property takes weeks, inspections, closing costs, and a real estate agent. That friction, which investors often see as a disadvantage, is also what protects Jake from himself during market panics. Many people who say they're long-term stock investors actually aren't because they sell when it hurts. Real estate forces you to stay in the game by making it inconvenient to get out. Part 8. Taxes, the hidden advantage of real estate. There's one more dimension to this comparison that swings significantly in real estate's favor, and that's the tax treatment. Real estate investors can depreciate a property for tax purposes, meaning the IRS lets you deduct the value of the building, not the land, over 27.5 years, even as the actual property value is appreciating. This creates paper losses that can offset rental income, sometimes making income from rental properties effectively tax-free on paper. You can also do what's called a 1031 exchange, sell an investment property and roll the entire proceeds into a new property without paying capital gains tax on the sale. This is the vehicle through which many real estate investors compound their wealth across decades without triggering massive tax events. Stock investors do benefit from long-term capital gains rates, which top out at 20%, and tax-advantaged accounts like Roth IRAs and 401ks are extraordinarily powerful tools. But the depreciation and 1031 exchange benefits in real estate have no direct equivalent in the stock market. Part 9. What nobody tells you about both sides. Let's spend a minute on the honest limitations of both paths, because every finance video that only tells you the upside is doing you a disservice. For stocks, the 10% historical average is real, but it's not guaranteed going forward. Some researchers believe future U.S. stock market returns may be lower, perhaps 6 to 7%, due to high current valuations. The decade from 2000 to 2009 averaged minus 1.4% annually. Starting point matters enormously. If you started investing in January 2000, your first 10 years delivered almost nothing, despite holding through everything. And the inflation-adjusted return matters more than the nominal return for real financial planning. After 3% average inflation, 10% nominal becomes roughly 7% real. That's still excellent, but it's not 10% in today's purchasing power. For real estate, the leverage that amplifies your gains also amplifies your losses. In 2008 to 2012, home prices fell by 30% nationally. Jake's $500,000 property would have dropped to $350,000, while he still owned close to $400,000 on his mortgage. He would have been underwater, trapped, unable to sell without losing everything he put in. Leverage is a multiplier in both directions. And being a landlord is not passive. I don't care how many Instagram posts say otherwise. Being a landlord is running a small business with physical infrastructure, legal obligations, and unpredictable human beings as your customers. If that sounds appealing to you, great. If it doesn't, that matters. Part 10. How to actually think about this decision. So, how do you decide which path is right for you? Here's the framework I'd actually use. Choose stocks if you want liquidity and simplicity. You don't want a second job. You're uncomfortable managing property or dealing with tenants. You're investing inside a tax-advantaged account like a 401k or Roth IRA where you're getting additional tax benefits. You want to start investing without needing a large lump sum. You can invest in the S&P 500 with $50. Choose real estate if you're comfortable with complexity and active management. You want to use leverage to control assets beyond what your savings alone could buy. You're in a market where rental income can genuinely cover your costs. You have the stomach to stay through down markets when you can't sell quickly. You're interested in the tax benefits of depreciation and 1031 exchanges. And here's the answer that nobody wants to hear, but almost every wealthy American eventually figures out. The most effective long-term strategy is usually both. Use stock market index funds inside your 401k and Roth IRA for the tax advantages and compounding power. Use real estate if and when you have enough capital and time to do it correctly. Let the two strategies work together, diversifying across different types of assets with different risk profiles, different tax treatments, and different roles in your financial life. The people who win over decades aren't usually the ones who went all in on one philosophy. They're the ones who built multiple streams of income and multiple types of assets and had the patience and discipline to stay invested through every cycle of the economy. Here's where we land. Marcus's $672,000 after 20 years of index fund investing represents something rare and underappreciated. Nearly zero time investment after the initial setup, complete liquidity, and a track record backed by 100 years of historical data. That is genuinely extraordinary. Jake's real estate journey, done well, likely produces a higher total return on cash invested due to leverage, but it required 20 years of active management, substantial ongoing costs, tax filings, and a willingness to deal with the full reality of being a landlord. Neither is wrong. Both require discipline, both require patience, and both will completely outperform the alternative, which is leaving your money in a savings account earning 0.5% while inflation quietly eats it alive. The debate isn't really stocks versus real estate. The real debate is, are you doing something, or are you still waiting for the perfect moment to start? Because the one thing both Jake and Marcus have in common, the one thing that actually produced those returns, is that they started at 30 with what they had. The market doesn't care when you feel ready. It just keeps moving, with or without you. I'm Ash, and I'll see you in the next one.